Stocks analyzed in this video are Pan American Silver Corp, Tesla, Alphabet, Upstart Holdings, Wayfair, Tesla, NIO, Ford, and Nvidia. Goldman Sachs has upgraded Telstra's shares to a buy rating with a target price of $4.60, implying potential upside of 13%. The broker cited the company's defensive qualities, positive growth outlook, and potential monetization of InfraCo fixed assets as reasons for the upgrade. It forecasts fully franked dividends per share of 17 cents in FY 2023 and up to 20 cents in FY 2025, equating to a total potential return of 17% for investors over the next 12 months. As per Yahoo Finance article dated January 29, analysts have made substantial upgrades to Pan American Silver Corp's, TSE, PAAS, next year's statutory forecasts, resulting in more optimistic revenue estimates of $2.2 billion in 2023, a 41% improvement compared to the last 12 months. The company is expected to have a faster growth rate of 31% compared to its historical growth rate of 17% and faster than the wider industry's forecasted growth rate of 11%. The consensus price target remains unchanged at $20.96. The upgrade of the revenue estimates for next year may prompt investors to take another look at Pan American Silver. Seeking Alpha's article talks about Lasaka, which is a South African fintech listed on the Nasdaq Stock Exchange that is considered to be cheap, undiscovered, and undergoing a change in management and board. The company is estimated to own non-core assets worth $40 million and has an estimated enterprise value of $427 million. Trading at 0.7 times EV/sales multiple and 7.6 times EV/EBITDA multiple based on 2023 sales and EBITDA estimates of $613 million and $56 million respectively. Analysts believe that the stock has an 80% upside potential to reach a target price of $8 within the next 12 to 18 months due to a transformative acquisition that has transformed the company into a dual-sided fintech ecosystem targeting both merchants and consumers. The company is expected to grow its revenue at a CAGR of 20% and has only penetrated 2% of its large total addressable market. Fool.com website article dated January 29 mentioned the market outlook is optimistic as growth stocks such as Alphabet, Upstart Holdings, and Wayfair have shown signs of recovery after a rough year. However, caution is advised as the market is coming out of a bubble and there are concerns about the underlying businesses that need to be addressed. Alphabet is facing a lawsuit from the U.S. Department of Justice and 8 state attorneys general alleging monopolistic practices in the digital advertising market which could impact its revenue. Upstart Holdings, a lending technology company, is facing uncertainty over whether it will be classified as a technology company or a lender, as its balance sheet could play a significant role in the stock's valuation. Wayfair, an online furniture retailer, could face challenges in recovery as its losses are back, and big tech companies like Amazon can compete with its AI capabilities and logistics network. Though, as usual, the article did not provide a definite buy or sell signal for these stocks. For some F stocks, we again researched Fool.com articles and found this article that mentions in 2023, the electric vehicle (EV) sector is expected to see growth as EVs become more mainstream, making up 10% of all new cars sold globally in 2022. Europe and China are leading in this growth, with fully electric vehicles accounting for 11% and 19% of new vehicles sold, respectively. Investors are advised to invest in a diverse mix of EV makers in 2023. Tesla remains the industry leader in the EV sector with strong business results despite declining stock prices. NIO, a China-based company, is looking to compete with Tesla for market share in the biggest global markets but remains a speculative investment as it has yet to make a profit. Ford offers diversity in a mix of EV names and has a low P/S ratio, but still needs to show profit on its electric offerings. The same-day article in Fool.com provided some commentary on Nvidia as well, mentioning that Nvidia is a semiconductor pioneer that has been impacted by the bear market. Despite declining revenue in its 2023 Q3 and a drop in earnings per share, the company has a history of growth and remains the leader in the discrete desktop GPU market. The decline in gaming revenue was due to the combination of soaring inflation and rising interest rates, but the data center segment saw growth driven by demand from cloud computing operations. Nvidia is the partner of choice for major cloud providers such as Google Cloud, Amazon Web Services, and Microsoft Azure, and demand for data center capacity has increased. The stock is currently selling at a high price-to-sales ratio, but it is worth the investment due to the company's history of above-average growth and robust future prospects.